Hi, this is Chris Matten from PwC at the RiskMinds conference in Amsterdam, December 2015. And it's my great pleasure to be joined this morning with Professor Ed Altman, who has been coming to this conference for a long time now, right?
Yeah, probably about 15 years.
Wow.
Not every year.
Okay, that's great. It's great to have you back. Now, I remember several years ago you were at one of our PwC dinners, and because your field of research is in credit and credit risk, and so when there are no defaults, it's kind of slim pickings for you. But when there are defaults, then life gets more interesting. So I remember you saying that when you have an Enron or something like that, the first thing you do, you and your wife open a really good bottle of wine. So have you been stocking up the wine cellar for 2016?
Well, actually, we've been not only stocking up, but opening up a lot of bottles of wine actually in 2015.
Okay.
Even though the default rate is still below the historic average, it's creeping up to almost that level, which is 3.5% of the high yield bond market,
right,
which is the historic average. And this year, of course, led by oil and gas and mining companies, it's already about 2.6%. And so we've had quite a bit of liquidity, if you will, in the Altman family this year.
And what's your outlook for next year?
Actually, it's for the first time since 2009, our outlook is for above the historic average. I think our numbers are 4.25%.
Okay.
Compared to 3.6 as an average. So the first time above the historic average since 2009.
Okay. And is this what you've been talking about at the conference this morning?
Well, that was one of the things. Mainly talking about the credit cycle and are we in a bubble with respect to the growth of leverage and the potential bursting of that bubble. And indeed, the bubble is building, in our opinion. Probably will not burst, if it does at all, for at least another year or two, but there are a lot of signs out there that it could, in fact, lead to another double-digit year, maybe in 2 or 3 years from now.
So double-digit, you mean double-digit default rates?
That's correct.
Wow.
Yeah,
okay.
10%. And 10% in today's market is much more drastic than 10% that we've had 3 times in the past.
And why is that?
The size of the market.
Okay.
It's now 1.6 trillion in the U.S., high yield. In Europe, about 520 billion euros. And the rest of the world, another 300-400 billion. So the leverage finance market, and that's just bonds. If you add leverage loans, it's $3-4 trillion.
Wow.
So it's a big market, and we've been living in a low interest rate, low default rate environment ever since the great financial crisis, and we think that cycle is coming to an end.
So that's 300 or 400 billion of defaults you're predicting.
If you're talking about 10% of 3 trillion, and just high yield bonds, 10% would be in the U.S. would be 160 billion.
Wow.
And we've never had more than 100 billion, so
right.
it would be
it's going to be
quite dynamic and drastic.
So all the banks that have spent all this effort boosting up their capital buffers are
they're going to need that capital if we have that 10% year again. Of course, the regulators are doing what they can to rein in the leverage lending, but I believe in the corporate area they haven't been very successful.
And you're talking not just about the US, you're talking about the US and Europe, or is this a global thing, or is it predominantly US?
That's a good question. I think the US is much more vulnerable than Europe. Europe has grown a lot in high yield leverage finance, but not as risky within that market. The so-called real trash, the triple Cs. The US has been somewhere between 15 and 25% of the high yield market in triple Cs, whereas Europe is under 10% of the new issues. And so they've been more conservative, and their growth has been, let's say, more higher creditworthy firms than the U.S.
Okay, well, that's quite a sobering outlook.
Well, it's something to keep in mind. It's very easy to continue to lend in this high liquid, low interest rate environment fueled by central banks. It's much more courageous, if you will, to get off the train when it's speeding down the track or at least to hedge your risk or reduce your exposures.
Right. So if everybody else is still lending and you stop lending, then you're going to get criticized by everyone else.
Especially if you're wrong. Especially if you're wrong, you might lose your job.
Yeah.
As opposed to if you get off the train and you're right to get off, you're a hero, but it just means a big bonus.
Right.
And so the risk-return trade-off of being courageous is not symmetrical.
Right. Okay. Which is something actually that Richard Thaler was talking about yesterday with behavioral economics. The incentive, as it were, to not exercise self-control when nobody else is exercising self-control.
Yeah, exactly. Yeah. I would agree with that.
Okay.
And I had some interviews with bank presidents, not interviews, but interactions, where they expressed that difference in risk versus return on their own credit actions.
Okay, excellent. Well, thank you, Ed.
You're welcome.
I guess it's probably time to put down some 82 Shadow Petrus and wait for 2017.
Be nice if you can send me a case.
I'll see what I can do. Thank you so much.
You're welcome. My pleasure.